Good morning, everyone, and thank you all for joining us. This is Margaret Nelligan with Airden Burles, and I'm very pleased to be presenting this morning with my colleagues here on the M&A markets for the cannabis industry. We have with us here today two very special guests, Vahan Ajamian, who's a capital markets professional with Beacon Securities and has over 11 years of equity research experience and covers the cannabis sector at Beacon. You'll note that Vahan is often quoted by the news outlets, so you'll hear his name often, including Bloomberg and Globe and Mail and the National Post. So we welcome Vahan and very glad to have you with us this morning. We also have with us John Medlin, who is with Blair Franklin. Blair Franklin's one of Canada's, or is Canada's, leading independent M&A advisor. And John has over 10 years' experience in M&A mandates and is focusing on the cannabis sector, as many of us are. Also with me here is my partner, Sherry Altschuler. Sherry and I are part of the capital markets group at Airden Burles, and we have an active practice in the cannabis sector. So we're very happy and excited to be here this morning to talk about a very active sector and a very quickly changing landscape for the industry as we move towards the rec market and full decriminalization and legalization of cannabis. And that's perhaps how I'd like to start off with a question that I'll pose to our two guests and to Sherry, which is maybe we could have ask for a few comments on the state of the market in M&A right now vis-a-vis the opening, which is going to occur in summer or late summer. And are we seeing a flurry of activity now that we expect maybe to fall off as the rec market approaches, or are we going to see changes based on that timing of the opening of the rec market? So, Vahan, perhaps I'll pass it to you on that question.
Sure, yeah. I think the large transaction late in 2016 where Canopy acquired Metrum, I think there was a lot of speculation at the time that would spark consolidation, a wave across the sector, and it actually didn't really happen. So most of 2017, I guess the companies felt that they had enough time. Most the capital markets were very, very hot for most of 2017. So firms instead tried to grow organically. So there was a lot of bought deals, there were a lot of financings, a lot of expansions because you had the time now to build a 1 million square foot greenhouse or build an expansion to your facility. I think now with rec, a handful of months away, you don't really have the time to do that anymore, right? Not that the industry is going to end on day one, but you don't have time to go out and do a financing and do an expansion of your own facility and grow organically if you want to get more product on the shelf for the start of recreational sales. So I think that's been one factor as to why M&A has accelerated in the last couple months.
Wonderful, thank you. John, any comments on that?
Yeah, I think the back half of 2018 will very much be a show-me market where once recreational is legal, we're going to expect companies to start showing their revenue and the extreme growth that's expected from them as the market matures. And companies who don't put up the numbers that are expected will be punished in their valuation. So I think if companies are starting to be worried that they're not going to be ready with their product in time, if they're worried about their distribution network or gaining that early market share lead, I think they may look for a transaction before rec and before that sort of show-me market starts. So that may drive some M&A before the legalization date or before the fall when those first results come out for the legal market. So I think there may be some in that respect. Companies who are well positioned and have developed the distribution networks in each of the provinces, I think will be feeling very comfortable about the market and will not want to see any inward transactions or in the next time, because I think they want the opportunity to show themselves.
Great, thank you.
Yeah, listen, companies are clearly trying to bolster their competitive positions by strategic acquisitions and brand building. And Vahan, touched on LPs, acquiring LPs in order to increase the production capacity. But what we're also seeing are other forms of transactions, such as brands buying brands, like the Doja Tokyo Smoke transaction. We're seeing companies buying expertise. We're seeing celebrity endorsements and other strategic type transactions. Just this week, the Gene Simmons transaction with Invictus was announced. And I think that we're going to continue to see more of that as we lead up to legalization, as companies try to establish their market presence.
Thank you. And just thinking of companies that are out there and listed right now that may be the subject or become targets in this market, what can they be doing and thinking of now to best prepare themselves for a possible hostile or approach from another player in the market when they really don't see themselves as their vision of their future is not in a merger with someone? John, perhaps I can toss that one to you.
Yeah, that's something we spend a fair amount of time with companies across all industries on, is that defense preparedness plan. And it's good to plan ahead of the event actually happening, because once you get into the throes of a transaction, things start to happen quite quickly. The rules changed last year, so you have more time to respond, 105 days to respond to a public hostile transaction. So there's a bit more time in there, but it's good to have a plan ready to go, and the expectation of a board of directors should be that management has a plan ready in the face of a transaction. The typical practice in Canada is that a hostile approach will be made privately first. It's rare that the first approach is made in the public markets. It's often referred to as a bear hug letter that you receive from another party, the aggressive party, saying that we would like to acquire your company. We'd like to do it with you. We'd like your support in that. If we don't get your support, we are prepared to go directly to shareholders in a hostile transaction. So during this private approach time, you want to have a plan ready to go. You want to have a sense of what your value is, and some metrics around that, and a plan at least to have a sort of a method at which to evaluate it laid out, and then a plan of who else may be bidders. In terms of responding to this, it depends on the facts at the time. Is the aggressor one of the most logical bidders and one of the bidders who could pay the most for your business? If they're not, you definitely want to go talk to those parties. And you may not want to kick off a wholesale auction. A just say no approach may be appropriate. But you want to evaluate the likelihood of the aggressor party actually taking the bid public. Will they want to go through that expense? It's once they kick off a public hostile M&A process, they put themselves at a bit of a disadvantage because they don't get access to non-public information. The subject of the bid can go out and sign up a white knight, and they can get access to non-public information, and so there are risks involved in becoming the aggressor in a public hostile. So you have to sort of weigh all of these aspects in the situation at hand, and that's a time where you need good legal and financial advice, quite frankly, from people who have been through it before to help the board through the situation at hand.
Thank you. And as Sherry and I engage a lot of our time advising boards of directors on these types of activities and readiness, and it's very important for the board to behave in a good way when they're approached. And one of the things, and we'll get to this a little later because I think we'll be spending a little bit of time on value, is really understanding before any bear hug is received or any unsolicited offer might be received, that you do have a sense of your value in the marketplace, and so that you're not reacting with a knee-jerk reaction to what the offer might be. You're acting from an informed base. And you also have to follow the process well at the board level if there's any of these unsolicited bids that come in. And there's a fine line between how much management is involved in the discussion at the board. Typically, management is involved right at the beginning. They're in the best position to provide the best information to the board. But at some point in the process, the board needs to step away and have an independent group, special committee, or independent committee assessing that unsolicited bid. So you need to make sure companies that are in this situation need to make sure that they follow that process right right from the beginning. There may be actually a lot of unsolicited bids that have been received but never go public because they're rejected by the board for good reasons. They were never disclosed because they never advanced to the point of disclosure. So the M&A activity can be going on where the market doesn't know it's going on yet because the disclosure activity hasn't arisen. But it's important even before disclosure or full-on M&A activity that the board follow those right processes.
And it's important because it becomes part of the record in the public disclosure eventually. Mm-hmm. If you do get to a transaction, you have to sort of tell the whole backstory.
You do. You have to tell the whole, right from the very first approach. Even if that wasn't the ultimate successful bidder, you have to tell the whole story right from the very first approach.
I will just make a comment that what we've seen in the cannabis sector is that boards are sensitive to act very carefully, and maybe more so even than other sectors, just because there's such a spotlight on the cannabis sector right now. It's a new sector, and people don't want to misstep. So the governance practices have actually been quite impressive for the companies we've worked with and seen in the cannabis space, for sure.
So turning just to a different topic in the M&A market, we had a small discussion about this before we started, but let's talk about cross-border M&A. And so we're seeing Canadian companies list down in the United States now. We're seeing United States companies coming to list here and outside of Canada companies. I'll turn it over to Vahan and John. Can you comment on what you might see developing in a cross-border market, M&A market?
Sure. Yeah. So, exactly to your point, we've seen companies like Kronos obviously file on to list on the NASDAQ, and now since they've kind of trailblazed that road, we're seeing others talk about wanting to get there as well. Most companies, though, that are TSX listed up here in Canada will not enter into the United States for in terms of direct acquisitions because of the whole TSX issue. They don't want to risk being delisted. Whereas we're also seeing U.S. operators listing here in Canada. And actually there I think it's more likely to have cross-border situations where a U.S. operator, for example, who wants to establish a Canadian presence, they're already public on the CSE, they can start buying private company applicants in Canada. And that's one way you can get cross-border collaborations or M&A. Another one, which was announced earlier this week, was Kronos Group entered into a 50-50 JV with MedMen, one of the largest U.S. cannabis company, operates in the 3 big states, to set up a retail JV in the provinces that allow it in Canada. So giving the Canadian company Kronos exposure to leverage the existing good U.S. brands, and offering the U.S. company, which is actually looking to go public next quarter, access to the Canadian recreational cannabis market where they have expertise.
John, do you have any comments on that?
I think for the past year, the valuations haven't necessarily allowed the U.S. companies to look into Canada because valuations in Canada have been more robust. I think we're starting to see that even out a little bit. So I think that the northbound M&A activity may pick up through the back half of 2018. There's some great CSE-listed companies that could look that have U.S.-based operations that could look north to establish a presence up here. And as Vahan said, very hard for TSE-listed companies to look south, just given the rules at this time.
Right. We're still under those restrictions with the TSX.
Yeah, we saw Cantros, if anything, divested their U.S. operations so they could uplist to the TSX.
Right.
And similarly, Afria divested of Copper State Farms, which is their Arizona cannabis operations, just because of that concern with maintaining their listing with the TSX as well.
So we've been talking about a fair bit about aggregation of LP capacity and driving the M&A market right now and leading up to rec. But there's obviously, as Sherry pointed out before, lots of other M&A activity going on. I'm interested in your thoughts on the bigger players in this world, being the pharma and tobacco and alcohol. We've seen the Constellation Brands deal, but do you see more of that happening? And I think we probably do, but what do you see the timeline on that, if there's a timeline of expectation for the really bigger players to get into this market?
I think when the Canopy Constellation deal was announced, September, October last year, We had talked about it in the past. This was something that could eventually happen down the road. But we, and I think most industry observers were surprised how quickly it happened. I think especially last year, most people were still twiddling their thumbs, saying, well, recreational sales are still a year away, and then edibles and drinks will be another year behind that. So we have time to figure out and see what we want to do, and then you see the big transaction with Constellation and Canopy, and all of a sudden, the sense I'm getting is that kind of was a wake up call to everybody in the sector. Okay, well, that obviously it's game on for these types of partnerships, and nobody wants to sign up with the 8th or 9th best dance partner, right? So people are now I would imagine, in high gear, trying to figure out what types of alcohol tie-ups make sense, and obviously we've seen other ones with pharma. This week with Tilray and subsidiary of Novartis, and CanTrust has been tied with Apotex for quite a while. So.
Yeah. The Tilray Sandoz one is an interesting one because they're going to team together and build a focus on non-smokable products and brand building with joint logos. And I think that's where we'll see a lot more traction from the pharmas going forward.
And pharmas have an incredible distribution network through their detailing reps, and that it's a very traditional network that's been there for centuries in a sense. So tapping into that distribution network is going to make a big difference in the medical area, I would think. John, any comments on the bigger players?
I think from the tobacco world, it's such a consolidated market in tobacco that they are willing to be late and wait and see who establishes themselves as the largest and most successful companies in the space, and they would be happy to do a deal later on once the market has matured, and they'll be happy to pay up at that time for the assets. But I think the tobacco industry is more likely to be late than early into the space.
And that perhaps is a segue to another question that we had discussed earlier, is that we've now heard from the federal government that the intention seems to be moving towards white labeling of products in Canada and suppression of brand. And in terms of the bigger players and even smaller players, is that going to have an effect, or do we think that might have an effect on the appetite for people for acquisitions in the Canadian market, or are there other plays on brand that the Canadian companies can do to keep their M&A appeal up?
Well, I think that the Kronos MedMen announcement, coming together in order to develop branded products and open stores across Canada, is an indication of where that may go and where that how companies may still get traction in getting branded goods. Doing, not celebrity endorsements, because of course that's not permitted under the legislation, but having celebrity partnerships, like we've seen a number of the players, whether it be the Tragically Hip, Bob Marley's family, most recently Gene Simmons, is another way that I think that we're going to see companies developing market presence.
Yes, I agree, and the Kronos and MedMen thing was discussed already. But even I think a year or so ago, Organogram was one of the first ones to have a partnership with TGS, the green solution in Colorado, to help leverage their brand and leverage their expertise as well regarding extractions. How do you make an edible? How do you make a vape pen? So to leverage existing U.S. brands that have been around for a while, have developed a certain level of expertise and brand awareness, and help sort of import them, not literally, but leverage them into Canada to get their brand awareness.
It's a little unfortunate in that it's going to be easier to develop a brand in the U.S. than it is in Canada, and I think that will play in the long term to the U.S. brands ultimately having a much bigger presence in Canada long term. I think it puts the Canadian players at a bit of a disadvantage in terms of being able to develop their own branding up here, just the different rules between Canada and the U.S.
So I'd like to take it back now to one of the bigger questions, I think, in this whole area is how do you establish value when you're in the middle of an M&A transaction? Having acted as the counsel to the Special Committee of Metrum, I can attest to firsthand knowledge of dealing with a volatile market while trying to establish the right exchange ratio. and the work that the special committee had to do during those weeks of negotiating the transaction with Canopy. So it's a big question because it's a new industry, but I think there's some challenges. But I'd like to maybe hear about what you think the approach is and why that's different from regular M&A, and then perhaps we can follow from there as how do you advise a board of directors as to whether or not they're accepting the right price for their company. So Vahan, perhaps I'll start with you on the valuation approach.
Sure. So in terms of valuation, the vast majority of transactions, especially the larger ones, have been paid substantially all in shares. So I think given the state of the industry, where we're still at an embryonic stage, we haven't most companies are still in expansion mode. Recreational sales haven't yet started. It's an emerging industry. It's very difficult to say what I'm worth and what you're worth and what's the right price for my assets and your assets. Obviously, you can do a comparison, whether it's where's last quarter revenue or square footage, number of patients, etc. Or now you're starting to see supply contracts. And I'm on the shelf. I will be on the shelf with province X, and you won't, etc. But I think given the fact that it's an emerging industry, you don't have the traditional, I trade at 12 times EBITDA and I buy companies at 7, right? That doesn't exist yet in this sector, so it becomes a relative game. We saw this in earlier industries, for example, in social media back 4 or 5 years ago when Facebook bought WhatsApp, right? Essentially, they were large platforms, both growing very quickly. Great intangible value there, but it was hard to say what one is worth. But if you can come together and do it mostly in a share transaction and say, well, at the end of the day, I'm worth 4 times more than what you're worth. And when we do a transaction, I should own 80% of the shares, and you should own 20. I think that's the way deals are getting done right now, and that seems to be sensible given the stage of the industry.
John, any comments on the approach to valuation from your point of view?
For sure. I would agree with what Vahan said. It is very much a relative value exercise in the market given the early stage. We take a very fundamental approach to valuation, so we will look at a discounted cash flow model, the important thing being that the overriding assumptions for both the target and the acquirer, we use a similar set of assumptions for both in terms of margins and growth rates going forward. And to the extent there are differences, we'd want to be able to explain why we think Company A is going to have higher margins than Company B. Maybe it's scale, maybe it's different quality, but we'd want to be able to explain any of those differences. And we build out the discounted cash flows, likely use the same discount rate for both, similar assumptions, and that provides us sort of one frame. And then we'd look at a number of different metrics, as Vahan said, to both look at what exists today and much of the value is on the come. So where are they going in the future in terms of supply agreements, opportunity for expansion, etc. So you want to recognize what exists today plus the opportunity that lies ahead on a relative basis. But we also want the fundamental value of a discounted cash flow so that we have something to ground it, understanding that it's based on a lot of assumptions and a lot of unknowns going forward. But if we're using similar assumptions for the two companies, it should produce useful relative answers.
Well, I think Margaret touched on it already. Is part of the challenge here is that we're trying to price deals in a very volatile market. And the Aurora Canamed deal was a perfect example of that. When Aurora first went out, I think the initial share price was around $24. By the end, it was $43, and it was a $1.1 billion deal and turned into a friendly deal. Afria Nuvera, which we also saw this year, the valuation from the initial price of $800+ million to the reduced price was about $450 million. And the market swings definitely create challenges in terms of pricing these deals and getting them done. One of the things that we look at and that we deal with as lawyers on these deals is the enhanced scrutiny from the regulators when there is share price volatility in the context of a transaction, and how that relates to confidentiality and access to information. And so one thing that we advise clients who are in this process and in an M&A process is the importance of non-disclosure agreements, and also right at the onset ensuring that you're keeping track of each individual who has access to information or is being made aware of the transaction, the date on which they become informed of the transaction, and because all of that disclosure may be requested by the regulators.
And just to supplement that a bit, in any transaction, M&A transaction that occurs in the Canadian capital markets, if there has been volatility in the stock prior to the announcement of the transaction, the parties involved will most likely receive a letter from the regulators asking them to disclose to the regulators all of the names of the people who had information about the transaction, when they knew, home phone numbers. A lot of information has to go to the regulator. And this is a standard practice of the securities regulators. So in the cannabis sector, where you have constant market movements in stock completely unrelated to M&A activity, the pattern of that trading will be most likely triggering these letters that will come as soon as a transaction is announced. So there, while, as John says, governance in the cannabis industry has been very strong right from the outset, most companies have been very good about building strong boards and a good ethic around their governance, that still there is a requirement for heightened sensitivity on confidentiality around all these transactions. And as we know, there are, I think, conferences every week in the industry, and there's lots of talk, and everyone just needs to be conscious of the fact that M&A deals, of course, are strictly confidential, and you can't trade if you have knowledge of it. So it's particular to this industry that there's a heightened focus on confidentiality and a heightened focus on keeping strict tabs on who knows prior to a transaction being announced. So just talking a little bit more about the boardroom and what boards of directors need to do. One of the things in preparedness as well, John, going back to your comments about making sure that the board is ready, is having an idea of who those independent directors might be that might oversee the warm bear or the bear hug approach and the unsolicited letter, and helping the board through that process. And maybe you can comment, in terms of, I spoke before about management being involved and then management being separated. Do you see that happening within the cannabis industry, and are they following that to make sure they have the processes that they should have?
I think that there is definitely a focus on that, and that they do follow those. Management in these cases is, I guess it can be said for any company, but is so linked to the business and are typically the founders and have been driving the business, and have the relationship with the board is almost different than the relationship you have in a much more established company, just because it's so identified with management. So that separation probably happens a little later than would be ideal, just because the management's input into the process is so important from an information standpoint, from an industry knowledge standpoint. But there is an inherent conflict with management. An M&A transaction could lead to the end of their vision, certainly, and their ability to have that vision for their company, and potentially their employment. So there is a conflict there, and that separation needs to occur. I think it does occur, but probably a little later than would be ideal.
Right, and it's a fine balance because the board relies on management implicitly to keep them fully informed. And the board actually feels separated from management through this process as well, because it's not that they operate in a vacuum, but they don't have management at the table all the time to fill in all the answers to all the questions that they're dealing with. But the way I've seen boards dealing with it is that there's a very good dynamic, and you make sure that you have management's input whenever it's required, but there is also all the time allotted and necessary that the independent directors will be able to be alone in a room and discuss without management present, and free from any constraints of and concerns that there's a conflicted person in the decision-making process.
Right, and we often start the call, like if we're in a process, and we'll start the call with management on the phone, and then go in camera with the committee once management's answered any questions that are relevant to the discussion at that time. So I think management's still part of it, but then the in-camera session needs to happen without management there to make the decisions that need to be made.
So going back to the sort of beyond Canada's borders, we've talked about the U.S. and Canada and how we're seeing sort of a crossover of listings and M&A activity. Beyond Canada, any thoughts on the jurisdictions that might be active in coming into Canada? And is it more Europe central? We hear a lot about Israel and the state of their market, which is quite advanced from a technology point of view. Any thoughts about outside of the U.S. and Canada?
Sure, yeah. We've seen a lot of M&A activity, actually, mostly from Canadian LPs, given their size, given their balance sheet and financial resources, going overseas. So, for example, in Germany, both Canopy and Aurora have acquired distributors. Canopy has obviously made some acquisitions in Denmark. Actually, so has Aurora. Australia has also been a very interesting area where obviously medical cannabis is legal and also emerging. We've seen Aurora, Canopy, and Kronos all look, and as well as MedRelief, all take stakes of various levels between 10 and 50% in Australian producers. I think it's the first step towards the industry going truly global. You start off by being a leader in your own country, and then you look overseas. You find the right local partner. You come to some sort of agreement in terms of ownership, and you you use your leverage and your IP and your expertise elsewhere where it's federally legal to kind of keep the playbook going.
I would just add to that, the Canadian LPs have a real chance to be global leaders in this market, and they have shown that going into other markets, as Vahan said. And Canada, they have a head start. It would be great to see that momentum continue and make sure that the regulatory framework continues to develop in a way that encourages Canadians to be leaders in this sector.
And certainly, we've seen there's Uruguayan companies listed on the exchange, and we'll be seeing more of that. But it does give rise to then reaching into the emerging markets, for which Canadian regulators have special rules and heightened sensitivities. So, in some of the emerging markets in Colombia and elsewhere, are there any pitfalls there for M&A activities that you see, or do you see them just developing the same as other opportunities?
They are actually progressing. We've seen even some in other areas. Like Supreme yesterday announced an acquisition of 10% of a company in Lesotho, South Africa, in part of South Africa. I think it remains to be seen to what extent these areas like Colombia, like Uruguay, will actually be able to successfully export, be it CBD or cannabis, into Canada or elsewhere. It may be easier given the lack of infrastructure and jobs and sort of political decisions to export it elsewhere where there isn't a kind of homegrown industry like there is in Canada.
When you're dealing with emerging market jurisdictions, an emerging market, just for the benefit of the audience, is really anywhere that's not Canada, the United States, Western Europe, Australia, and New Zealand, of course. And because of that broad definition of emerging market, when you're dealing with any of those jurisdictions, if you're a company that's listed, for example, on the TSX Venture Exchange, they have an emerging market policy that will have enhanced requirements for governance on closing of any go public transaction. There are enhanced requirements for your audit committee. There's enhanced qualifications and evidence of qualifications for your CFO and your auditor that you have to submit. And they may also, for a TSXV issuer, make you have disclosure controls and procedures and internal controls over financial reporting that are similar to those of a TSX bid board listed company rather than a venture issuer. In addition to that, when you're dealing with emerging market companies, one of the threshold questions in any international jurisdiction, for that matter, is showing the lawfulness of the regulatory landscape in that jurisdiction and how the company's activities fit within that landscape. And most often, if not always, that's provided by way of a legal opinion. And so you really need to have, an ability to deliver a clean legal opinion to either the exchanges and also to any underwriters or agents that are on the deal who are diligencing your deal about the lawfulness of your activities if there's any international reach in them.
Thank you. So looking at other markets as well, besides just geographical boundaries, we talked a bit about, the big players, tobacco, alcohol, and pharma. What about agriculture? Do you think that there are plays there? We see some integrated M&A activity in terms of, extraction techniques, and do you think that there's any possibilities there, or is that just not an industry that's going to enter into this space?
Well, the one company that's been very aggressive on the agriculture side into cannabis is Scott's Miracle-Gro, right? So they obviously fundamentally they're more of a fertilizer manufacturer and supplier, but we've seen them get into HVAC systems for cannabis, fertilizer systems specifically for cannabis, lighting technology for cannabis. So we're seeing there one situation where a large U.S. multi-billion-dollar company is looking more for the, not the growing specifically, but the picks and shovels, ancillary services that agricultural businesses need to get into the sector. It's pretty interesting.
How about the Canopy Green hemp transaction? Is that sort of a move towards larger scale outdoor?
We're definitely seeing more kind of buzz around hemp, but with Canopy as well as Aurora, they are looking at hemp as a way to get outdoor crops, hemp on an industrial scale, and then obviously to extract the CBD for medicinal purposes.
And we also see companies like Aurora, completing acquisitions of companies. Larson, the greenhouse facility design company that's ancillary to the production business, but rounds out its business. They also have made plays in technology as well related to cannabis.
I see we have a question that's come in from one of the listening audience, and it's just a clarification question on the 105-day period that John mentioned earlier in the takeover bid process. John, can you just elaborate on that, and perhaps maybe we can talk a little bit about rights plans and the role as well in terms of how this works. So.
For sure. So the 105 days was reference to the new rules that came out around hostile bids about a year ago, maybe 18 months ago. And it just gives longer for the target company to reply. This increased from 45 days previously, I think it was. 35 days previously. So it provides a lot more time for the company to run a full auction process in the face of a bid and find a white knight. And it certainly felt like a long time in the Canamed Aurora deal. And maybe you can touch on how the rights plan and then the lockups were there. That was more of a legal
yeah, certainly. Well, I think this is one of the questions that public companies face, not only in the cannabis sector but elsewhere, is do you still need a rights plan with 105 days in order for a bidder? So if a bidder has to keep their offer open for 105 days, that gives plenty of time, as John said, for the company to find a white knight or look for alternatives or build their campaign to just say no. And traditionally what Canadian companies had done in the past, when it was only 35 days, was put in a rights plan, and the rights plan effectively stopped any bid from happening. So if anybody acquired more than 20%, the rights plan would kick in and massively dilute the person who acquired the 20%, so that they did not get any extra shares, but all the other shareholders in the company received a massive number of shares in it, and it diluted the hostile acquirer down. And so most companies that were widely held and didn't have significant positions of major shareholders would put a rights plan in place so that under the rights plan, only a permitted bid could proceed, and a permitted bid had to follow a certain amount of time that it was open. It had to provide for, take-up of all the shares and so on. And it essentially really put a lock on the company unless you could fit yourself into this permitted bid category. What it did, though, was it allowed the target company to control the process. And because the permitted bids had to be within a certain have certain terms and conditions. If a bidder wanted to have something outside of the terms of a permitted bid, they had to go talk to the company and try and find a friendly deal. So now we still have rights plans, and they will have some effect. But you do have more time, and I think in recent decisions in the last 10 years or so, companies are in a better position to just say no. But they're going to have a good market campaign to explain to their shareholders why they are rejecting an offer that the bidder is saying is at a premium of 30 or 40% to market. And that's what takes us back to the big challenge with value and making sure that everyone understands what the value is. Because when a bidder comes in, they'll say, we're bidding a huge premium to market. The shareholders of that company would not want to see their board standing in the way of the shareholders receiving that value. On the other hand, the board is entitled to say, no, we have a vision for the company. We believe our vision is stronger and better than what the bidder is proposing. And we are going to recommend to shareholders that they don't accept this bid because it's not enough to outweigh the vision of the company that we see. That's a legitimate consideration for a board. So I think, certainly we saw it with the recent transaction, and there the values changed. But generally, what the board is trying to get to is a situation where they're actually in control of the process. When you have an unsolicited bid, you have to deal with that. But you may, if you're going to start an auction as a board, then you would try to do a soft test of the market or a full auction. But if in doing so, you would secure confidentiality agreements with all of the interested bidders, and in that confidentiality agreement, there would be a standstill provision that says, while we're in this process, you won't start to acquire shares. And that implicitly may be the requirement anyway. If they have inside information, they couldn't acquire shares. But the board, in imposing standstill requirements, actually starts to control the process, can run an orderly auction, and at the end of the day can say yes or no, depending on the indicative offers that they receive in. So the rights plans are still there in a lot of companies. Whether they're needed or not depends on particular company. And one of the other dynamics for targets is there a major shareholder, or is there a group of major shareholders that has to be brought on side in order for that M&A transaction to work? So if you have a 20% holder or 3 holders that hold 30% or 35%, a transaction is not going to happen unless those particular shareholders agree to the bid and to the price and the terms of the bid. And that's where the lockup agreements come in that John mentioned. So a bidder will want to have individual agreements with those major shareholders, they agreeing that they will in fact tender into the bid on the terms promised, and they will commit to provide their shares into the bid. If you have effectively positions that are in the 20 and 30% range, that's an effective poison pill right there, because a hostile bid's not likely to happen unless those people fall into place. So that all, it dovetails with the 105-day period. You can make a hostile bid, but if you never have a chance of getting that 30%, then your hostile bid is not likely to prevail in any event.
We received another question that I'd like to put to Vahan and John, and it's which companies or types of companies are most likely to be acquired? We're seeing all sorts of sectors and ancillary industries, but if you had to get out your crystal ball, what activity do you think we'll see going forward?
I think extraction is probably going to be the big one. We're seeing, obviously the larger companies have extraction technology, but a lot of the up-and-comer and even the mid-tier companies that are the producers don't really have any extraction capabilities, expertise. Where if you look again to the United States, in California, there's companies that specialize specifically on extraction and brand building. So I think, as we see some new categories of licenses of processors as they come up and demonstrate that their expertise in extraction, I think that's one area where companies will look to be acquired. The other one I think is distribution. Right, using M&A to get away into distribution. Obviously, we saw Aurora acquire essentially almost control liquor stores for the purpose of transforming those stores into cannabis stores. And I think this is where Canopy Rivers really comes into play. If you are a up-and-coming producer, or you need financing, you need a regulatory expertise, but most importantly, you need distribution to get on the shelf. And we see some of these new, up-and-coming late-stage applicants, or they just got their license, they're still some time away from growing. Well, how are you going to get on the shelf of the LCBO or the SAQ if you're late to the game and you don't go through, for example, Canopy? Right? It's going to be very, very difficult. So I think using distribution or M&A as a way to get distribution as well as extraction is going to catch on.
I would agree with your last point there that the sort of late stage applicant or recently licensed parties who still have a requirement to raise funding. It may be a more difficult market to raise funding in the back half of 2018. They may look to M&A to get that capital, and it may be northbound M&A, it may be U.S. companies looking to buy an LP in Canada, or large Canadian LPs looking to expand their footprint. But I think we'll see more of that activity through the rest of 2018.
So, Vahan, going back to your comment on extraction then and different technologies, are we seeing, do you think then that the M&A activity is going to drive towards more fully integrated companies as opposed to, just using the services and licensing the technology, or is that where we're heading with a lot of the M&A activity?
There'll probably be a bit of both, right? You will get some companies that specialize in certain niches, whether it's extraction or distribution or just simply growing or just basically branding. So there will be certain segments, but I think ultimately many companies will want to be vertically integrated. They'll want to have that soup to nuts, seed to sale and branding and everything with it. So I think as companies decide their focus, right? I want to be big and I want to capture the entire value chain, or I want to specialize in one niche and be the best at it. We'll see M&A sort of flow with the direction that companies want to do it, but want to take. But I think both of those approaches will prevail. So
just to segue on that, then, would you approach the value of a company that's fully integrated different from a value that's just a single play? Is there a different mindset or a different metric that you would use in that type of scenario? Yeah,
I think that they would probably catch a premium because you're the master of your destiny to a greater extent. You're not reliant on a few suppliers that may have quality issues, or you may make a great product but can't get on the shelf, or you don't know how to brand properly. I think if you can do everything from A to Z, you can get the better valuations. We're definitely seeing that in the United States. That some of the companies that, if, for example, if you're a supplier or if you're a producer in the States where there's just too much supply and you don't have your own stores and there's significant price compression in some U.S. states, like Oregon, for example, if you don't have the stores and you can't capture the entire margin, you're at a disadvantage to somebody who can sell their own product and capture the retail margin, or maybe even enhance it given the weakness in that case on some of the production margins from competition.
Right.
Yeah, I'd agree that that's something probably looking to mining, where you see premiums for companies that have multiple mine sites in operation versus a single site miner. I think from a more fundamental approach, when we're looking at a discount rate, a diversified company would attract a lower discount rate just because there's some of the risk is dealt with through having multiple or different operations. Just to touch on discount rates for the industry, I mentioned earlier that discounted cash flow was a key element of how we look at companies. And the discount rate is a key input or key assumption in that an early stage market or industry like the cannabis sector would typically require a higher discount rate, just given the risk. A number of reasons in the cannabis sector why we use a lower discount rate. One is that the market already exists. It just happens to be in the dark, illegal market. You're not having to educate users on the market. They're there today. You just need to convert them to the light market. The market's also going to be supply constrained out of the gate. A few years down the road, that might be a different story, but certainly early on, there's going to be supply constraints. It's a very regulated market, which we think helps reduce some of the risks. And there is a huge global opportunity where Canada is a leader, and they can take it beyond our borders. So for those reasons, we end up using a lower discount rate, which increases the value when we're looking at a fundamental analysis.
And going back to fully integrated, is there risk for some companies that don't appear to be so integrated as they may have an unfocused approach where they're in too many pockets, but it doesn't seem to be seed to sale? Are you seeing that happen at all in terms of approach to value, and they suffer from their?
It's still kind of early to say whether they suffer from their approach to value, because everybody is right now predominantly a grower. Some companies like Supreme have said specifically, we want to be focused on growing. That is that is our core competency. That is our expertise. That's what we're going to be focused on. Whereas obviously others are going to go through the whole soup to nuts. And the theory being, if I can be a specialist at something, in their minds, they'll be able to garner higher value, right? But they have to, obviously, like every other company in the industry, you're going to have to prove out that that expertise and that premium in the specialty that you're claiming.
All right. And just thinking of the timeline to summer and the opening of the rec market, I think implicit in a lot of the activity is the expected requirements for production on the rec market, and that assumes that enough for a certain proportion of the black market is going to move over. And so one of my questions is in M&A, do you think there might be a wait and see period to see exactly what happens on that transition with the black market? Will we see a little softening of market M&A activity, not only for the reasons you pointed out, John, but perhaps we still have to see how this actually plays out in Canada with the opening of the market? Any thoughts on that?
Yeah, I think some companies will take a wait-and-see approach, but I think most are going to be plowing ahead. I think the black market is not going to go to zero overnight by any means. It'll take several years to whittle it away. But on the other hand, what we're also going to see is new entrants into the market, right? People who haven't been cannabis consumers really at all. They don't know where it comes from. They don't necessarily trust what's happening in the black market. They feel much more comfortable, walking into an LCBO or equivalent, and knowing that when I buy a bottle of Grey Goose, it's a bottle of Grey Goose every time, and it's inspected and everything. So that'll translate to cannabis. I think if you look at some of the states that have been around with legal cannabis for a number of years, like Oregon, Washington, Colorado, the number of people who use cannabis actually went up for about 20 to 30% a few years after legalization versus a few years before legalization. So it is attracting some of the maybe they may be less hardcore users experimenting, but there should be an increase there. So I think that being one factor, companies will still look to pursue M&A, knowing that it may take some time to eradicate the black market, but ultimately the size of the pie should be growing.
Okay.
Yeah, there really are four things that I think people cite when they talk about derailing or deterring the black market. And our government has, to different degrees, particularly at a provincial level, been trying to move towards that. And the four things are that the price has to be right, the quality of the product, and I think our LPs in Canada are doing a great job with getting rid of pesticides and improving the quality of the product. The variety, so variety means not just dry bud, but we want capsules, we want extraction, and when the edible market comes online in hopefully 2019, that'll be a big one. So variety of product. And then the consumer experience. The OCS store model in Canada, which we were all calling, I think, the CCBO stores before OCS came out with that great brand. $650,000 brand.
Spent a lot of money on that one.
Is one approach, and it's quite different than what we're seeing in other provincial jurisdictions that will embrace more of a retail model. And what will be interesting to see is how those jurisdictions are, if they are better able to derail an illegal market because they have enhanced consumer reach.
Thank you. And we have another question from the floor, if you will. And this is just a clarifying question about are we seeing a lot of multilateral instruments? 61101 related party transaction in this sector. So I think this requires a clarification. When we talked about special committees, because the question goes on to ask what are the key points special committees should be aware of. When we talked about special committees and independent committees in M&A, it doesn't have to be a related party transaction in order to require a special committee for a public company. The special committee, the independence is the independence from management. As John mentioned, the livelihood of management is at play in an M&A transaction, whether those particular people in the C-suite are going to continue in the new company, whether they're not going to be continuing, or whether the company that they built from the ground up is not going to be the company they're running anymore, is very relevant personal considerations to those individuals. So they are considered non-independent for the purposes of assessing the value of an offer for the company. So the independence is independent of management, and we still call that a special committee, even though it's not a full-blown 61-101 transaction, which is the related party transaction rules for securities in Canada. And also, even though it's not 61-101, almost all transactions have a fairness opinion from a financial advisor. And the financial advisor advises that the transaction is fair from a financial point of view to the shareholders, and it's an important part of the board's due diligence to get that opinion and have that opinion so that they have received expert advice in giving their recommendation to shareholders to either accept or reject the bid. So just clarification on that, but that's the role of the special committee.
If I can touch on the MI 61-101, this industry is probably an industry where we will see less related party transactions, just given the nature and the stage of the industry. Those tend to be more going private transactions, which I don't expect to see. Maybe if you have some companies stumble and they want to take it private, but I think that's quite a ways down the road.
Even with the bigger players like Constellation Brands didn't take over 10%, so they wouldn't be a related party if they wanted to do something further. I mean, there would be special considerations, but we're not seeing that in the industry because there isn't the consolidation of ownership yet.
Right.
We see a lot of it in Canada because there is a lot of consolidation of ownership in a lot of our public companies, and that's why we have a special rule for related party transactions. But this sector is so new and so widely held for the most part that we wouldn't expect to see that. And that's why things like the 105-day period are important, because most companies are widely held and most companies are vulnerable to a takeover. They don't have those blocks of shareholders that could block a bid or have to be on board for a bid to occur. So we'll see less of it, I think, as well. So we're just wrapping up in the last couple of minutes. We've talked about where we think things are going and where they'll slow down. John, you mentioned you think we'll see a softening in 2018, at the back end of 2018. Do you think 2019 we'll see a pickup after the dust settles and we see where everything is?
Yeah, sorry, I might clarify that. I think it's sort of a separation of and maybe to a degree that's already started to happen, but I think that really the back half of 18 will be an opportunity for companies to show that they've arrived. There'll just be a separation of the leaders and the rest of the pack, I think, as we go through 2018. There'll always be opportunities, I think, for new technologies, the extraction side, as Vahan spoke about, the edible side. As that comes in, I think there'll be new darlings and new winners in those spaces. But I think once recreational becomes legal, the market will expect to see results posted through 18 and 19.
Yeah. Any comments, Vahan, on that?
I agree. I think but come late 18 or early 19, it's gonna become obvious who are the winners and the losers, who got their product on the shelf. Who didn't get their product on the shelf, who's actually making money, which companies did the LCBO or OCS stop acquiring from because customers complain about the poor quality. I mean, we're going to start to see all this shakeout. You'll probably see another run in terms of stock prices leading up over the summer to legalization, and then the rising tide will lift all boats, and then we'll have to see who actually makes it and makes money and who doesn't. Right.
Well, thank you. And obviously more to come on this, and I think we'll be seeing a lot of activity for a while. So Vahan and John, thank you so much for joining us, and Sherry. I want to thank everyone for joining us today, and we would just like to remind everyone that we have another webinar coming up myth-busting the cannabis sector on International Cannabis Day, which will be on 4/20, so from 2 to 3 in the afternoon. So please check your emails for an invite, and we'd love to have you join us for that one as well.
Yeah.
And thank you all.
Thank you.
Bye-bye.